So whether you have an LLC, you have an S corp and C corp, you have a trust, you have a W-2, understanding the legal structure upfront sets the tone of how much you're gonna go from left to right, right? So that's another thing that we do. Bill, LLCs are passed through all the time, right? There is no really benefit. Having an LLC, having a social is more or less the same thing. It gives you an idea of doing some cost optimization. That's about it, right?
So the same LLC, generally speaking, is a pass-through. However, there's really no such thing as being taxed as an LLC. Generally, in real estate, it's disregarded, which is another way of saying you own it, but you don't even have to file a separate return for it. However, you can elect, you may be an S Corp or a C Corp or a trust, but generally speaking, LLCs are passed through. They're treated the same thing as if you owned it with no entity. It's there at the state level, but the IRS, sometimes they really don't care.
Thank you. So we have an income W-2, which is based on our social. Then second one, it happens at the LLC, another layer. LLC gets you some additional benefit to it. But then you take the LLC, stack up to number two, which is the S Corp and C Corp, depending on which way you want to swing it. But S and a C, different structure, different need, different requirement, but that has additional benefit that you can get. You can have 401k, you can have employees, you can pay you, your spouse, all this other benefit to it. Another way, as your income grows, your structure typically will go from W-2 to LLC to S to C Corp to trust. And trust becomes another one. This is a heavy way to go. If you ask me, I didn't know it better before. Everybody should have at least a base level trust. So there's the transition of the ownership of the asset across the family. It gets pretty smooth. So the trust is the last one, right? So trust is the way that you can kind of go, and you can design it one trust versus two trusts versus you stack it. We like what we call it spendthrift, non-revocable statutory trust. That gets you the max amount of benefit, I believe. And so with that, you can decide whether you want a 2 or a 3 S Corp and C Corp, but your legal structure will set the tone which way you're going to go. So for me, I have LLCs. We debated on the corp. I didn't do it. I want to trust. But initially, when I thought about it, it was beneficial because me and my wife, then you can have 401k. That 401k gets rolled over to the other 401k. There are a lot of other benefits to it. So Bill, would you talk a little bit about the corporation, and if we have a company on the corporation and one spouse is working, how can you hire the other spouse, and how the 401k gets set up and they can match that way as well?
Yeah, it's so the biggest difference between the S corporation and the C corporation, S corporation, while it says corporation, is still a flow through entity. So any of the income or loss that is incurred in that entity, the S corporation, it'll actually get reported on your personal income taxes. The nice part, the profits from an S corporation are not subject to Social Security or Medicare tax. The counterbalance of that is the IRS says you have to take a paycheck. Now, that's good, but generally, I don't like owning real estate inside of an S corporation because little secret is profits from real estate are not subject to Social Security, Medicare tax either. And you might be limiting your deductions if you have a mortgage. They're excellent opportunities for service-based companies. Just sometimes you kind of want to make sure before you do it that way, what are you doing? C corporations are kind of like their own person. They pick up their own income, they pay their own expense, and then the net profit, it's a flat 21% tax. For some people, maybe that's more than what they're paying now. For a lot of people, that's less. So if you're trying to generate cash after tax and you're going to have income, sometimes a C corporation is the right way to go. A great benefit of the C corporation is C corporations are allowed to pay for things like health insurance, sometimes long-term care insurance, certain types of other life insurance, benefits that can go to the owner employees that may not have the same deduction when they're self-employed. C corporations are, if you're not a US citizen or you're not a US resident and you're buying real estate inside the United States, highly recommend that that foreign national own a C corporation for their investments. Reason being, if that real, and when that includes investing in a multifamily deal, because if not, the leads, whoever runs the multifamily deal or yourself, whenever there's distributions or profits, they're holding money back, sending it to the IRS, and you as a foreign national have to file returns to get your money back. Even if you have a loss, they don't care. They take it off the top. They don't take it off the bottom. Now
That's thank you,
trusts,
bro.
yep, trusts. Just understand the word trust is about like saying car. You know, I could have a Hyundai, I could have a Chevy, I could have a Ferrari, I could have an F-350 pickup. And some people might say, you know, hey, well, which one's the best? And, you know, I'd probably hear the answer, well, a Ferrari, of course. I'm like, great. Because I live on a farm and I got to haul, you know, a yard of manure. So Ferrari's still the best, right? Like, whoa, whoa, whoa. You got to know, why are you setting up the trust?
Yeah.
Certain trusts are appropriate in certain cases, but not others. Some of them are a really good idea. They just call it like a living trust or a revocable trust. Those are great for when you own property in other states and you don't want to have to go change the name for everything for your estate planning. But they don't do anything to protect your assets. They don't really protect things from shelter them from taxes. Then you've got other grantor trusts, you know, irrevocable trusts, spendthrift trusts. And so a lot of this goes hand in hand with your estate planning, because sometimes you can put all the money in, but you may not get the money out. Your kids will love you, your grandkids will love you, but you may have been like, oh no, I could have had a V8. So make sure when you're doing it, the one setting it up is doing it right. And to tell you, I know a lot about a lot of trusts, and there's still so many more I don't know. I'm learning new stuff all the time, but just make sure, you know, if you're going with someone, that they do understand what you're doing and why.
Thank you. The trust gets really complex, depending, you know, as complex as you can get, and it's a hand design almost. It's really crafted. You have to create the trust. You have to decide how money goes in, how money goes out, when does it go out, how it goes out, what's the money goes out to who, who's the trustee, who's the guarantor, who's the beneficiary, all those kind of things. But the benefit of the trust is that it doesn't the separation of ownership and the profit, right? That is a big deal. On the LLC, S corp, and C corp, they own the assets and they also own the benefits of the asset. With the trust, you separate that out. If you don't have the ownership, you can fight me all you want, but you're not going to get anything, right?
Yeah.
Which is different than just sharing the profit. So separation of that risk, trust is a very nice vehicle. Then S and C corp is really good, and LLC. So Bill, correct me if I'm wrong. If you're running a business that's making six figures or so more and you're projecting, you organically came into the corp side, and because the corp has some expense, but that by that time you're going to pay out your expenses already, then you can go trust. Once you hit that and halfway through $500,000-600,000, then it makes a lot of sense. Maybe at some point you'll stack it. You run the company on the LLC that reports to the corp, belongs to the trust, whatever the case might be, right?
Trusts are also great if you have a lot of assets and you're thinking about what's going to happen after you're gone. I mean, defer, 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 die. Well, maybe you want to control from the grave. Maybe you want to make sure that after you're gone, what you intend now will continue on. Trusts are a great vehicle for doing stuff like that.
Thank you. So I'm going to come back to the real world for a little bit, investment strategies, right? So we spend quite a bit of time asking the question, how do we offset some of the income that we have? So far, again, this is an example of it as you kind of go. The W-2, it is a hard one to offset. So far, what we have found out, there are certain solar investments, they're very long-term play, 7 to 10 years play. If you invest in those type of investments, that taxation and the benefit and the credit that you get, that offsets some of those income taxation that you have. Bill, any flavor you want to add to that one?
Yeah, absolutely.
Cool.
So it's offsetting your W-2 income, which is nice because many times passive investors, they get these losses from the real estate deals and they are a great long-term play. But there's a difference between saving taxes today and not paying taxes in the future. With the solar investments, when done correctly, there's no income limits, and it could be 30% of what you pay. So you spend, 20,000 to put this solar panels on your roof. This is now on your home. You might save $6,000 of tax. And that's just the tax savings. Depending on what you're doing, you might be saving on your energy costs. Depending on what part of the country you live, you might even be sending money back to the grid and saving money there. Now, that's on the home. There are also ways, if you have investment properties or you've got other businesses and you start putting solar on top of those, again, a lot of those credits could pass through. The amount of the credits and then start to become more tied to how many, kilowatts are you producing, how big are the batteries. But a good rule of thumb is that if you purchase one, it's going to give you a 30% tax credit. Now, the only word of warning I would give to that is make sure whoever you're buying them from is a good company. Because, okay, I hate to say this, people know you're getting a 30% tax credit. Some people might charge you a little more money because they know that you're just going to get it in the back end. This is actually a true story. My brother was looking at getting one, and the person that was selling it to him was like, "Oh yeah, by the way, we'll just remodel your kitchen. We'll give you new granite countertops, new sink, and don't worry, it's all under the same bill. We'll just call it under the solar credits." So my brother's asked me about it, and I was like, "Run! Do not go. I don't care if they do a good job on solar. Somebody who's willing to lie. Like, do not ever lie to the government. I'm proud to pay taxes. I'd be just as proud for half as much, but do not break the law." And I was like,
That's
"No,
right.
that's a shady character. Stay away."
100%. So follow the rules, follow the books. If the book says to do something, you do it. If the book says do not do it, don't do it, right? Fastest way to get to the orange jumpsuit with a big ticket item is those tax frauds, right? Then the second thing, what I would say, source of investments. We take a look at a pre-tax and post-tax, right? Pre-tax, post-tax, it could be again your source of money that you're getting. Which bank account? Is it the Roth IRA account? Is it your W-2 income account, which is your personal bank account? Is it your 401k? Is it your passive income reinvestments? Because passive income, return on a passive income will behave a different way than a return in your W-2 income, right? So understanding your source of capital. Last one is invest via trust, right? When you invest via the trust, it works a different way. When you invest via your passive income, you get depreciation that offsets you that. And the post-tax and the pre-tax, they'll behave a different way. So understanding that source of investments, source of your capital that's coming out, in a simple word, which account is coming from, whether it's a pre-tax or post-tax, will set the tone as well as you kind of go. And the last one that you have here is timing the exit or return. That sometime you can time that, hey, year 3 in 2026, within the year, I have potentially a sale coming up. I'm going to get some benefit. I'm working already. I don't get the tax benefit, but I'm going to invest today and I'm going to get a depreciation 50, 60%. So by the time I get to 2 years from now, I have 70% loss or 70 cents loss for every single dollar already on my hand. As a bank, I reserved it. So when I get a return, I offset that out. I'm only paying tax on the 30%. So sometimes you can plan that way. So you can increase the tax deduction. If you cannot get it to define, you kind of store it. So when the time the deduction happens, you can kind of exit it out. So putting it together, we have options. I love the IRA play. I love the solar 401k. Didn't realize I came from a W-2. I went through a typical investment. I've done a quite 1031 typical progression. From there, you go to the Roth IRA. You thought you found the next best thing. Then we'll figure out, oh, there's a solar 401k. So once you go to solar 401k, it was like you found the next best thing, and then you go, oh, there's a trust. So there's a evolution that we all went through. But the point is, now looking back, if somebody would have given this to me and said, Shariah, go sit down and go talk to your CPA and figure out where you're at. So you played the same game. So you don't have to figure out less. Every time you figure out, that's money, right? So on that note, the very first thing you can do, the 401ks are very good play, Roth and Solo. I'll give you kudos to Bill. Bill helped me transfer my 401k from Fidelity all the way down to Solar 401k. And guess what? That's money that I control. I get to buy anything that I feel like buying. And that availability, I didn't have it, but thanks to Bill, without paying, with the taxation, we followed the book to get to I had the control on the money in a very short amount of time. Now, Bill, that rule went away, right? When did it go away? The little that Sidra, the Sidra that we did.
So with the rules, so what we've done, we use
For me,
some of your income, we
Quattro,
convert to Roth.
Quattro. And that rule that we use, we did the Quattro for me, right?
Yes,
For us,
yes.
yes, the Quattro went away, right?
So yes, well, so what happened? One of the judges in Dallas said that it used to be the Quadro, which actually used to be like most people thought about in a divorce situation. One spouse has a 401k, they give their 401k to the other spouse. That spouse can cash it out, no 10% penalty. Then a judge in Dallas said, yeah, that doesn't work unless there's like marital strife or problems. We're not going to let a happily married couple do it. Now, the dirty secret is most counties in Texas, so in order to get it, a judge has to sign off on it. There's still a lot of counties in Texas that are like, yeah, we're not listening to that judge. So now, Harris County, Dallas County, Travis County, unfortunately, Bexar County, those aren't the counties that allow it, but there still are a few that will allow it.
Thank you. And I did the same thing. We're happily married, and it's still we transferred the 401k. Then without paying the 10%, we're able to transfer all the 401k to Roth 401k. Now that's thanks to the conversation that I had with Bill, right? So again, talk to your folks as you're gonna go through. Not gonna go into that, but this is ultimately it's gonna boil down to it's a decision, right? You can practice. You can go out there and decide, hey, I looked at my tax position and I have investment hypothesis, what I'm going to do next. I use massive capital as a case study. We have two projects, one with the depreciation and the cash flow, the other one is total velocity and high return. And reach out to Trevor, anyone in the investor relations team, talk this through, practice as you go, right? One has a 5 years hold time, one has a 3 years hold time, 50K minimum. One has 18 to 19, one has a 21 to 22. One is a 2.1 because it's the 5 years, other one is 1.6 because it's 3 years. One is a 70-30, one is a 70-30. Now this one doesn't get depreciation, this one gets depreciation. So depending on where you at, depending on what you want to do, it's there. And then the third one that we're going to add next week, hopefully, that's going to be another option, which is the debt fund, which is someone says, I want to cut coupon. I want to cut coupon. If I go to a credit union, I get 5% on my CD. After $100,000, there is no guarantee, but I have another option. I get 7-8% dividend day one, and my asset is backed by, or my investment is backed by an asset at a 70% of the value. So we worked quite a bit on the back end to bring that out. So you'll see that there's a third option. The whole point is practice as you go. And if you're not quite sure, pick up the phone. You can call Emily or you can call Trevor. You can call Jasmine, have a conversation and get that process kicked in as much as you can. And the faster you get into the process of decision making, it's going to be better for you.